Before we dive in, a quick and important note. I am not a licensed financial advisor, and this presentation is for informational and educational purposes only. The world of mortgages is complex, and individual situations vary greatly, so please consult with a qualified professional before making any financial decisions. You found it. The one. The house with the perfect kitchen, the big backyard, the school district you've been dreaming of. It's more than just wood and drywall. It's the next chapter of your life. You're filled with excitement. Then you apply for the mortgage, and a tidal wave of alien language crashes over you. Pre-approval origination fees, points, PMI, escrow, ARM, DTI. Suddenly, your dream feels like a pop quiz in a language you've never heard. You're handed a stack of papers thicker than a novel, and you're expected to sign on the dotted line, committing to the single largest financial transaction of your entire life. And here's the secret no one tells you. That feeling of confusion, that overwhelming complexity, it's not a bug, it's a feature. The entire mortgage industry is built on a foundation of information asymmetry. That's a fancy way of saying they know things you don't. And that knowledge gap is where they make their money. But not anymore. In this video, we are going to pull back the curtain and expose the entire mortgage lending machine in the United States. We're not just going to define a few terms. We are going to follow the money from your bank account all the way to Wall Street and back. We're going to reveal the hidden players, the secret incentives, and the fundamental truths that drive every single decision a lender makes. By the time we're done, you won't just understand the process. You'll have a framework, a new way of seeing the entire system that will give you the power and confidence to navigate it like an insider. To do that, you first have to understand the most important concept in this entire industry. There isn't one mortgage. There are two. First, there's the mortgage you see. To you, the homebuyer, a mortgage is a debt. It's a 30-year promise. It's a monthly payment that dictates your budget, your lifestyle, your financial freedom. It's a weight, a responsibility, a ball and chain that you slowly, painstakingly chip away at month after month for decades. It's the price you pay for the American dream. That's your reality. But that is not the lender's reality. To the lender, your mortgage is something completely different. To them, your mortgage is an asset. It's a product. It's a beautiful, cash-flowing, government-backed financial instrument that they manufacture and then sell for a profit. They aren't in the business of lending you money for 30 years. They are in the business of creating a product, your loan, and selling it as quickly as possible. Once you grasp this fundamental difference, that your biggest liability is their profitable asset, the entire industry snaps into focus. Every fee, every rule, every piece of paperwork suddenly makes perfect logical sense. So let's start at the beginning. Where is this product born? It begins with the very first person you meet on your journey. The loan officer. The friendly face at the bank or the voice on the phone. They ask about your family, your dream home, they build rapport. They seem like they're on your team, a trusted guide to help you through the maze. And many of them are good people who want to help. But you must never forget their primary function. They are not financial advisors. They are salespeople. Their job title is loan originator. Their entire purpose is to originate, to create the product. And how are they compensated? Almost always through commission. They get paid when your loan closes. The more loans they close, and often the larger the loans, the more money they make. This creates an immediate, fundamental conflict of interest. Their incentive is to get the deal done. It is not necessarily to get you the absolute best possible loan for your unique financial situation. It's to get you a loan you qualify for and to get it closed. This is why it's so critical to understand who you're talking to. Broadly speaking, you'll encounter two types of loan originators. The first is a loan officer who works directly for a retail bank. Think of a Bank of America, a Chase, or a Wells Fargo. They are a direct employee of that institution. The advantage is that it's a one-stop shop. The disadvantage? They can only sell you the products their bank offers. They have a limited menu. If their bank's rates are high that week, or their underwriting guidelines are extra strict, that's all they can offer you. The second type is a mortgage broker. A broker is an independent agent. They don't work for one specific lender. Instead, they have relationships with dozens of different wholesale lenders. They are a middleman. You go to the broker, fill out one application, and they can then shop your loan around to multiple banks and credit unions to find the best rate and terms for you. In theory, this competition should result in a better deal. The trade-off is that their fee, the broker commission, is baked into your loan, either through a slightly higher interest rate or through closing costs. Neither is inherently better or worse, but understanding this distinction, are you talking to a direct seller or a shopper? is your first strategic advantage. But whether you use a bank's loan officer or an independent broker, they are not the ones who actually approve your loan. They are the gatekeepers and the paper pushers. The real decision maker is someone you will never meet, never speak to, and who likely doesn't even know your name. They are the underwriter. The underwriter is the bank's risk detective. Their one and only job is to protect the bank's money. They don't care about the tire swing in the backyard or the beautiful granite countertops. They are cold, calculating, and look at your entire life, boiled down to a file of numbers and documents, and ask one simple question. If we give this person hundreds of thousands of dollars, what are the odds we get it back? To answer that question, they use a time-tested framework known as the 4 C's of underwriting. This is the rubric against which your entire application is judged. The first C is capacity. This is the most important one. It's not about how much money you have in the bank. It's about your cash flow. Do you have the capacity to make the monthly payment every single month without fail? They determine this primarily with your debt-to-income ratio, or DTI. They add up all your monthly debt payments, car loans, student loans, credit cards, plus your proposed new mortgage payment, and they divide it by your gross monthly income. That percentage tells them how much of your paycheck is already spoken for. If that number is too high, it's a massive red flag. You could have $1 million in the bank, but if your monthly cash flow is tight, you will be denied. The second C is credit. This is your financial report card, your FICO score. It's a numerical representation of your history and your reputation as a borrower. Have you paid your bills on time in the past? Do you carry a lot of high-interest debt? Your score is a proxy for your reliability. A high score tells the underwriter you're responsible. A low score tells them you're a higher risk. The third C is capital. Now we're talking about the money you have saved up. This is your down payment, your closing costs, and any reserve funds you have in checking, savings, or investment accounts. Why do they care? Because capital is your skin in the game. If you put down 20%, you have a significant financial stake in that property. You are far less likely to simply walk away and default if times get tough. A small down payment means the bank is taking on almost all the risk, and they will compensate for that by charging you more, usually in the form of private mortgage insurance or PMI. And the final, fourth C is collateral. The collateral is the house itself. You might be a perfect borrower with great income and a flawless credit score. But if the house you're buying isn't worth the price you're paying, the deal is off. The lender hires an independent appraiser to assess the property's fair market value. This is non-negotiable. They are not going to lend you $400,000 for a house that's only worth $350,000. Because if you default, they need to be able to sell the house and recoup their investment. The appraisal protects the lender, not you. So, the loan officer packages your file. The underwriter scrutinizes it against the 4 C's. They verify your income, they pull your credit, they review the appraisal. And after weeks of stress and endless paperwork, you get the magic word, approved. You sign the closing documents, you get the keys, you pop the champagne. For you, the homebuyer, the journey is over. Your story in that house is just beginning. But for the lender, the real game has just begun. Because that loan you just signed, that 30-year promise sitting in a file, it's now a finished product. And it's about to be packaged, priced, and sold to the highest bidder on Wall Street. And that is where the real money is made. To understand this machine, you first have to change your perspective. That loan document, that 30-year promise you made, is not a liability to the bank. It's an asset. It's a financial product that generates a predictable stream of income for 360 months. And just like any other product, from a car to a stock, it can be sold. But why would your local lender sell it? Didn't they just go through all the trouble of originating it? The answer is simple, and it's the key to the entire American housing market. Liquidity. Think of your lender as a bucket maker. They have a limited supply of wood. They can build a bucket, and then they have to wait for someone to come and fill it with water one drop at a time for 30 years. That's a terrible business model. They'd run out of wood after making just a few buckets. They would have no capital left to lend to the next person who walks in the door. So, what if they could build a bucket, immediately sell it to a massive water distribution company for a small profit, get their wood back, and instantly start building the next bucket? Now they're not in the water waiting business. They're in the bucket making business. Their profit comes from volume. Originate, sell, repeat. This is the fundamental engine of mortgage lending. The lender doesn't want to wait 30 years to get their money back. They want it back now so they can lend it out again to someone else and collect another set of origination fees. So they take your mortgage and they sell it. But who are they selling it to? Who is this massive buyer with an insatiable appetite for American mortgages? For the most part, we're talking about two companies you've probably heard of, but might not fully understand: Fannie Mae and Freddie Mac. These are not your typical companies. They are what's known as government-sponsored enterprises, or GSEs. They were created by Congress with a specific mission: to provide liquidity, stability, and affordability to the mortgage market. They are the giant, ever-thirsty buyers in the secondary mortgage market. They stand ready every single day to buy qualifying mortgages from the lenders who made them. So, your little local bank bundles up your loan maybe with a few dozen others they closed that month and sells the whole package to Fannie Mae. The bank gets its cash back plus a small premium. They're happy. They now have a fresh pile of cash to make more loans. But what does Fannie Mae do with your loan? This is where the real financial alchemy begins. This is where your individual promise to pay becomes part of something astronomically larger. Imagine a giant financial smoothie blender. Fannie Mae takes your mortgage, let's call it a strawberry. Then they take a mortgage from a family in California, a banana. A mortgage from a retiree in Florida, a blueberry. They don't just take a few. They take thousands upon thousands of these mortgages from all over the country. Different loan amounts, different interest rates, different locations. They throw all of this fruit into the blender and hit puree. The result is a massive, blended financial instrument. You can no longer pick out the individual strawberry or banana. All the individual risks and characteristics have been blended together into a single, uniform product. This process is called securitization, and the smoothie they create is called a mortgage-backed security, or MBS. Now, why go to all this trouble? Because while very few investors would be interested in buying your specific mortgage, tons of investors are interested in buying a small, predictable piece of this giant, diversified smoothie. Fannie Mae takes this enormous MBS smoothie and pours it into thousands of smaller cups to sell to investors on Wall Street and around the globe. These investors are the big players: pension funds managing your retirement money, insurance companies, mutual funds, even foreign governments looking for a safe place to park their cash. Why do they buy it? Because that MBS entitles them to a share of the principal and interest payments from all the thousands of homeowners whose mortgages are in that pool. Your monthly payment no longer goes to your local bank. Instead, it flows through a servicer, gets sent to Fannie Mae, and is then passed on to a pension fund in Ohio, an insurance company in Germany, and a sovereign wealth fund in Norway. You, by paying your mortgage every month, are funding the retirements of people you'll never meet, in countries you may have never visited. And here's the genius of the system, the part that makes it all work. Fannie Mae and Freddie Mac do one more crucial thing. They add a special ingredient to the smoothie: a guarantee. They guarantee that investors will receive their payments, even if some of the homeowners in the pool default on their loans. For this guarantee, they charge a small fee, which is their primary source of revenue. This guarantee is everything. It transforms a messy collection of individual loans into a safe, standardized, and highly desirable investment. It's like getting a government-backed seal of approval, which makes these mortgage-backed securities almost as safe as U.S. Treasury bonds. So let's recap the journey. You sign the papers. Your local lender sells your loan to Fannie Mae to get their cash back. Fannie Mae bundles your loan with thousands of others into a mortgage-backed security, slaps a guarantee on it, and sells shares of that security to giant institutional investors all over the world. So win-win-win, right? The lender wins because they get immediate cash to make more loans. The investors win because they get a safe, steady return. And you, the homeowner, win. You might not realize it, but this entire complex system is the primary reason the 30-year fixed-rate mortgage even exists in the United States. In most other countries, a 30-year loan with a rate that never changes is a fantasy. Lenders simply wouldn't be willing to lock up their money for that long and take on that much risk. But because American lenders know they can immediately sell the loan to the secondary market, they are happy to offer it. This constant flow of capital from Wall Street investors back to Main Street lenders is what keeps mortgage rates relatively low and accessible. It's the hidden plumbing that makes the American dream of homeownership possible on a massive scale. Now, you might be wondering, who keeps track of my payment? If my loan has been chopped up and sold to 100 different investors, who do I call if I have a problem? This brings up the final, crucial piece of the puzzle: the servicer. Often, the bank that sold your loan will retain the servicing rights. This means that even though they don't own your debt anymore, they get paid a small fee to manage it. They collect your payments, handle your escrow account for taxes and insurance, and send you your monthly statements. They are the customer-facing administrative arm of the operation. Sometimes the servicer is a completely different company you've never heard of. This is why you might get a letter in the mail one day saying your loan has been transferred and you need to start sending your payments to a new address. The owner of your loan hasn't changed, but the company hired to collect the checks has. To you, it feels like your loan was sold, but in reality, your loan was sold long ago. It's just the paperwork handler that's new. This is the system working as intended. A well-oiled machine connecting global capital to local home buyers, creating stability and opportunity. It's a marvel of financial engineering that has housed hundreds of millions of people. But this machine has a fatal flaw. Its strength, the ability to take thousands of unique, individual loans and blend them into a uniform, seemingly safe asset, is also its greatest weakness. The system relies entirely on one thing: the quality of the ingredients being put into the blender. It assumes that the brokers and lenders on the front lines are carefully vetting every borrower, checking every document, and only putting good, healthy fruit into the mix. But what happens when the demand for these mortgage-backed securities becomes so frantic that the bucket makers on Main Street get careless? What happens when they start running out of good fruit and decide to throw in some that's a little bruised or even rotten? What happens when the entire system is designed to pass risk along so quickly that nobody is incentivized to check the quality of what they're selling? You get a smoothie that's toxic. And in 2008, the entire world was forced to take a drink. So how do you get an entire planet to drink poison? You make it taste sweet. You make it look like the healthiest, most profitable drink ever invented. For a few years in the mid-2000s, this toxic smoothie wasn't just being consumed, it was celebrated. The housing market was a rocket ship that only went up. People who never dreamed of owning a home were suddenly handed keys. Construction workers were making six figures. Mortgage brokers were driving Lamborghinis. And on Wall Street, they weren't just drinking the smoothie, they were bathing in it. The money flowing through the system was biblical. The machine was working perfectly. Too perfectly. The investment banks, the big smoothie shops like Lehman Brothers, Bear Stearns, and Morgan Stanley, were making billions by bundling mortgages into these mortgage-backed securities and selling them off. The demand was insatiable. Pension funds, university endowments, foreign governments, they all wanted a piece of the safe, reliable American housing market. They were lining up around the block for these smoothies. But this created a problem. Huge one. The smoothie shop was running out of good fruit. They had already used up all the prime mortgages, the loans given to people with good credit, stable jobs, and a hefty down payment. The demand for smoothies, however, was still screaming. So the shop sent a message down the line to the local lenders, the people actually meeting the homebuyers. We don't care about the quality of the fruit anymore. Just send us anything you can find. We'll buy it all. This is where the term subprime comes from. It was a race to the bottom. Lenders started approving loans that were frankly insane. They were called ninja loans. No income, no job or assets. You could literally just state your income with no proof required and get a mortgage for $500,000. These were the rotten, bruised, moldy pieces of fruit that, in any sane system, would be thrown in the trash. But in this system, they were the fuel. The investment banks knew this fruit was bad. But they had a brilliant and utterly catastrophic idea. What do you do when you have a bunch of smoothies that you know are a little questionable? You can't sell them as is. But what if you took the leftovers from 100 different smoothies, specifically the riskiest, pulpiest, most questionable parts, and you poured them all into one giant industrial-sized blender? You blend it all together, creating a brand new, impossibly complex concoction. This was the next step in the financial food chain. It was called a collateralized debt obligation, or a CDO. The logic, at least on the surface, seemed clever. If you have one bad mortgage, that's a problem. If that person defaults, you lose your money. But if you take 1,000 mortgages from all over the country, from Miami to Anchorage, from San Diego to Boston, and bundle them together, the risk is diversified. A few people might default, sure, but the vast majority will keep paying, right? The whole US housing market can't possibly collapse all at once. That was the bet. The entire global financial system was staking its future on that one single assumption. So they created these CDOs, these giant super smoothies made from the riskiest slices of other smoothies. And then they did something even more clever. They sliced the CDO itself into different parts, called tranches. Imagine the super smoothie settling in its giant vat. The safest, cleanest part rises to the top. This was the senior tranche. The investors who bought this slice got paid first. No matter what happened, the first dollars that came in from homeowners paying their mortgages went to them. It was considered ultra-safe. As safe as a US government bond. Below that was the mezzanine tranche. This was the middle part of the drink. A little riskier, but it paid a higher interest rate. These investors only got paid after the senior tranche was paid in full. And then there was the bottom, the thick, murky, concentrated sludge that settled on the floor of the vat. This was the equity tranche. This was the nuclear waste of the financial world. It was made up of the first losses. If even a small percentage of homeowners in that giant pool of mortgages started missing payments, this slice was the first to get completely wiped out. It was incredibly risky. But if, by some miracle, everyone kept paying their mortgages, the returns on this slice were astronomical. Now, you have this giant layered vat of financial goo. Who in their right mind would buy the top layer and believe it's perfectly safe when they know it's floating on a sea of toxic sludge? You need a stamp of approval. You need an official health inspector to come in, look at the vat, and declare to the world that the top layer is not just safe, it's AAA rated. The highest rating for safety and quality that exists. Enter the rating agencies. Standard & Poor's, Moody's, and Fitch. These were the trusted referees of the financial world. For 100 years, their job was to be the sober, impartial judges of risk. When they gave something a AAA rating, it was a universal signal to the world's biggest and most conservative investors. We're talking about the money that funds your retirement and pays your grandma's pension, that this investment was rock solid. And these rating agencies gave thousands of these CDOs, these super smoothies built from the worst parts of the worst mortgages, their highest possible rating, AAA. Why? Why would the trusted referees suddenly abandon their post? The answer is one of the oldest and most corrosive in human history. A catastrophic conflict of interest. Historically, rating agencies made money by charging investors to subscribe to their ratings. But in the 1970s, they flipped their business model. They started charging the companies that were issuing the debt. The investment banks were now the rating agency's customers. Think about our smoothie shop analogy. This is like the smoothie shop paying the health inspector directly for a 5-star rating. And if one health inspector, let's say Moody's, gets a little squeamish and says, "Hey, I don't know if I can give this thing a AAA. It seems to be made of rotten fruit and financial waste," the investment bank could just say, "Fine. We'll take our multi-million-dollar fee down the street to your competitor, Standard & Poor's." I bet they'll find a way to get comfortable with it. It was a race to the bottom. The agencies that gave the most favorable ratings got the most business. Their models were complex, but they were all based on that one fatal assumption. A nationwide housing collapse was impossible, so they stamped AAA on everything. They gave the poison a certificate of purity. And so, these financial weapons of mass destruction, disguised as the safest investments on earth, were sold to the world. They ended up in the pension fund for school teachers in Ohio, in the city budget for a town in Norway, in retirement accounts for millions of regular people who had no idea what a CDO was. They just knew they were buying something safe. Something AAA. For a while the illusion held. The money kept flowing. House prices kept climbing. But underneath the surface, in neighborhoods across America, the first signs of rot were beginning to appear. Those teaser rates on the subprime mortgages, the ones that started impossibly low, were beginning to reset to their real much higher interest rates. A family that was paying $1,500 a month was suddenly facing a bill for $3,000. The first few homeowners started to default. Then a few more. The toxic ingredients, long hidden at the bottom of the global financial system, were starting to curdle. The thing that the models said could never happen was beginning to happen. The entire system was a house of cards built on a foundation of bad loans, held together by fraudulent ratings. And most of the world was oblivious. But a handful of people, a few weirdos and outcasts on the fringes of Wall Street, were looking at this and not seeing a masterpiece of financial engineering. They saw the single greatest, most obvious fraud in the history of capital markets. And they realized something profound. You don't have to be a victim of the crash. You could, in fact, bet on it. You could buy an insurance policy on a skyscraper that you knew was designed to burn to the ground. This new financial weapon, this perfect insurance policy, was called a credit default swap, a CDS. And on the surface, it sounded incredibly boring. Sounded responsible, even. It was born in the mid-90s inside the gilded halls of JP Morgan, created by a team of brilliant financial engineers. The original idea was simple. Let's say a bank like JP Morgan lends $100 million to a big company, say Ford Motor Company. The bank makes money on the interest, but it also carries a risk. What if Ford goes bankrupt? The bank loses $100 million. So, the bank goes to an insurance company, a giant stable institution like AIG. They say, "Hey AIG, we want to buy some protection on this Ford loan." The bank pays AIG a small, regular fee like an insurance premium. In exchange, AIG promises that if Ford defaults on its loan, AIG will pay JP Morgan the full $100 million. The risk is transferred. The bank is safe. IG collects easy money because hey, when was the last time Ford went bankrupt? Seemed like a win-win. A responsible way to manage risk in a complex global economy. But somewhere, deep in the machinery of Wall Street, this simple, elegant idea was twisted into something monstrous. A small, almost imperceptible change in the rules of the game opened the door to the biggest casino in human history. The change was this: you no longer had to actually own the loan to buy the insurance policy on it. Think about that for a second. This is like you being able to buy fire insurance on your neighbor's house. You don't own his house. You have no financial interest in its safety, but you can go to an insurance company and say, "I'll pay you $100 a month. If my neighbor's house burns down, you pay me $200,000. Suddenly, you're not interested in your neighbor's fire safety. In fact, you have a $200,000 incentive to see his house go up in flames. This is what Wall Street created. They called it a naked credit default swap, and it transformed a tool of protection into a weapon of speculation. The market for these things exploded. In the year 2000, the entire market for credit default swaps was valued at less than $1 trillion. By 2007, on the eve of the crash, it was valued at over $62 trillion. $62 trillion. That's more than the entire economic output of every country on planet Earth combined. It was a shadow banking system, bigger than the real one, operating completely in the dark. There was no exchange, no regulator, no oversight. These were just private contracts between two parties. A gentleman's agreement with planet-sized consequences. And the biggest seller, the biggest bookie in this global casino was AIG, the American International Group. They were one of the largest insurance companies in the world, with a perfect AAA credit rating. They were seen as the bedrock of the financial system. And they were selling these CDS policies like they were printing free money. They looked at the mortgage bonds, these CDOs packed with subprime loans, and saw the same AAA rating that the bought and paid for rating agencies had slapped on them. To AIG, the risk of these things failing was statistically zero. So they sold swaps. Billions and billions of dollars worth of swaps, collecting the premiums, and booking them as pure risk-free profit. They were selling fire insurance on entire neighborhoods built out of gasoline-soaked cardboard, and they had convinced themselves it was the safest bet in the world. Now here is where the story takes its darkest turn. The very same banks that were building these ticking time bombs, the Goldman Sachs, the Morgan Stanleys, the Deutsche Banks, they were the ones creating the subprime mortgages, bundling them into bonds, getting them rated AAA, and selling them to pension funds and retirees around the world, telling them they were as safe as government debt. But at the same time, quietly through the back door, these same banks started buying credit default swaps on their own products. Let me repeat that. They were manufacturing a product they knew was defective, selling it to their customers, and then secretly placing a bet that it would fail. It was the ultimate betrayal. It was like building a car, knowing the brakes were faulty, selling it to a family, and then taking out a massive life insurance policy on them. They weren't just hedging their risk anymore. They were actively betting on the collapse they were helping to create. They knew the skyscraper was designed to burn because they were the architects, and they were first in line to buy the insurance policy. But they weren't the only ones. On the fringes of the financial world, a small handful of oddballs and outcasts were starting to see the same thing. They weren't the insiders creating the fraud. They were the outsiders who were smart enough to spot it. There was a hedge fund manager in California, a socially awkward former neurologist who preferred to work barefoot in his office, blasting heavy metal music. He didn't talk to Wall Street analysts. He didn't watch financial news. He did something nobody else was doing. He actually read the documents. He sat down and went through hundreds of prospectuses for these mortgage bonds, page by tedious page. And what he found terrified him. He saw that these bonds, rated AAA, weren't filled with safe 30-year fixed-rate mortgages. They were filled with the garbage we talked about. The ninja loans. The adjustable rate time bombs. The 2 and 28s. He realized the entire foundation of the global financial system was a lie. The skyscraper wasn't just flammable. Someone was already standing in the basement with a lit match. So he did something that seemed insane at the time. He went to the big Wall Street banks, the very ones selling these bonds, and he asked to buy credit default swaps on them. He wanted to bet against the American housing market. The bankers on the other end of the phone literally laughed at him. The U.S. housing market had never collapsed. Not once in its history. It was the bedrock of the economy. They thought he was a fool, an idiot throwing his investors' money away. But they were more than happy to take his money. Of course, we'll sell you insurance on something that will never fail. It's free money. So they sold him hundreds of millions and then billions of dollars worth of these swaps. Around the same time, a loud, obnoxious trader at Deutsche Bank in New York came to the same conclusion. He sent his team out to the mortgage fields of Florida and California. And they came back with horror stories of strippers owning 5 houses and strawberry pickers with 7-figure mortgages. He knew it was a bubble of epic proportions. So he too started buying up credit default swaps, creating a massive position that bet against his own bank's products. His bosses thought he was crazy. His colleagues mocked him. But he kept buying. In a handful of other hedge funds from New York to Colorado, a few other contrarians saw the same writing on the wall. They were all, independently, coming to the same conclusion. The system was rotten to the core, and it was about to implode. They were buying earthquake insurance in San Francisco. They were buying hurricane insurance in Miami. The rest of the world saw blue skies and a booming economy. They saw the storm clouds gathering on the horizon. These few outsiders had now placed the largest, most audacious bet in the history of finance. They were betting against the full faith and credit of the United States housing market, and by extension, the entire global economy. Every month they had to pay millions of dollars in premiums to the big banks and to AIG. It was a slow, agonizing bleed. The banks on the other side of the trade were laughing all the way to, well, the bank. They were collecting millions in free cash, waiting for these crazy bets to expire worthless. For a time it looked like the outsiders were wrong. Housing prices kept going up. The subprime loans hadn't started defaulting in large numbers yet. The premiums were draining their funds. Their own investors were starting to panic, demanding their money back. They were right, but they were early. And in finance, being early is the same as being wrong. They had bought the insurance policy. They were paying the premiums. They knew the fire was coming. Now all they could do was wait for the world to start burning. And for men like Michael Burry, Steve Eisman, and the handful of others who had bet against the American housing market, that waiting was pure agony. Imagine knowing with absolute certainty that a hurricane is about to make landfall. You've boarded up your windows, you've bought the insurance, you've told everyone you know to get out. But the sun is still shining. Your neighbors are laughing at you, calling you a paranoid fool. And every single day, the insurance company sends you a massive bill. A premium for a disaster that everyone else insists will never happen. This was their reality through 2006 and into 2007. They were bleeding money. Millions of dollars a month flowing out of their funds just to maintain their bet. Their investors were calling, screaming. Some were pulling their money out. The pressure was immense. It wasn't just financial, it was psychological. They were staring into the abyss, and the abyss was just staring back, costing them a fortune every single day. The most infuriating part? The system was actively working against them, almost as if it had become sentient and was protecting itself. Even as the early data started to trickle in, showing that delinquencies on subprime mortgages were ticking up, the value of their insurance policies, the credit default swaps, wasn't increasing. In fact, sometimes the banks they bought them from, like Goldman Sachs or Deutsche Bank, would mark the value down. It was madness. It was like buying fire insurance on a house where you can smell smoke, see the wiring sparking, and the insurance company calls you to say your policy is now worth less because officially there is no fire. This is a crucial concept called marking to market. The value of an asset is what someone is willing to pay for it. But with these complex mortgage bonds, there was no active market. So the banks, the ones who had sold the insurance and stood to lose billions if the bonds failed, got to decide what they were worth. And surprise, surprise, they kept marking them at or near 100 cents on the dollar. It was a system of institutionalized denial. Then, on April 2, 2007, the first major domino wobbled. A company called New Century Financial, one of the largest subprime mortgage lenders in the United States, filed for bankruptcy. For the average American, this was a blip on the financial news, a headline quickly forgotten. But for those watching closely, this was the equivalent of a mushroom cloud appearing on the horizon. New Century wasn't a bank that held mortgages. They were a factory that made them. They were the ones giving out the ninja loans, no income, no job, no assets. Their entire business model was based on originating these risky loans and immediately selling them to Wall Street banks to be chopped up and packaged into those mortgage-backed securities and CDOs. Their collapse meant the source of the raw material for the Wall Street machine had just been poisoned. The loans they had made in 2005 and 2006, with their low teaser interest rates, were now resetting to much higher rates. Suddenly, people's monthly payments were doubling, even tripling. And these were the most vulnerable borrowers, people who could barely afford the first payment, let alone the new, higher one. Defaults began to skyrocket. New Century was buried under a landslide of bad loans they couldn't sell. When they went bankrupt, it was the first public, undeniable proof that the foundation of the entire housing market was made of sand. Yet, Wall Street's reaction was muted. The official line from the banks, from the Federal Reserve, from the talking heads on TV was, "This is contained." It was a mantra they repeated over and over. The subprime problem is contained. They argued that subprime mortgages were only a small slice of the overall multi-trillion-dollar housing market. They claimed the sophisticated financial engineering of the CDOs had distributed the risk so widely that no single institution would be harmed. It was a comforting lie, one they desperately wanted to believe, because the alternative was simply unthinkable. To admit that the foundation was rotten meant admitting that the entire skyscraper they had built on top of it, the global financial system, was in danger of imminent collapse. To admit that would be to admit that the AAA ratings from Moody's and Standard & Poor's were worthless, that the models were wrong, that the entire business of turning bad loans into gold was a fraud. But while the executives in their corner offices were reassuring the public, a few traders on the inside were starting to panic. In the summer of 2007, two hedge funds run by the investment bank Bear Stearns imploded. And this was different. This wasn't some shady lender from California. This was Bear Stearns, one of the oldest, most respected names on Wall Street. These two funds had invested heavily in the most complex and riskiest tranches of subprime mortgage-backed securities. The same securities the rating agencies had stamped with their gold-plated AAA seal of approval. When the funds started losing money, their investors, which included other big banks, demanded their cash back. But the funds couldn't sell their assets. Nobody wanted to buy them. The market for these toxic CDOs had frozen solid overnight. This was the moment the disease escaped the subprime quarantine and began to infect the heart of the financial system. The Bear Stearns failure was a terrifying signal to everyone on Wall Street. If their highly paid quants and PhDs couldn't navigate this market, who could? It proved that the risk wasn't contained at all. It was everywhere. The banks that had lent money to the Bear Stearns funds were now stuck with the worthless mortgage bonds as collateral. Suddenly, every bank began looking at every other bank with deep suspicion. What toxic waste are you hiding on your balance sheet? If I lend you money, will I ever get it back? The trust, the grease that lubricates the entire global financial machine, was evaporating. And for the small group of Cassandras who had bet against the market, this was their moment of vindication. The value of their credit default swaps finally began to soar. The smoke was no longer theoretical. The fire was visible. The world was finally starting to see what they had seen all along. But the feeling wasn't one of triumphant celebration. It was a cold, creeping dread, because they were now realizing the true scale of the problem. This wasn't just about a few bad loans or one or two over-leveraged hedge funds. They had bet against a single tower, but they were now watching the entire city begin to crumble. The numbers were so large, the connections so intertwined, that the collapse they had predicted and profited from was threatening to take down everything and everyone with it. The system wasn't just broken. The system was the problem, and it was now eating itself alive. The entire global financial system, a complex machine built on centuries of trust and transactions, was now grinding to a halt. The oil in the engine wasn't just low, it had turned to sand. Credit markets froze solid. The invisible hand of the market was suddenly clenched in a fist, threatening to crush everything. This wasn't just a housing crisis anymore. It was a crisis of everything. A crisis of confidence. A complete systemic meltdown. The money that flowed between banks, the lifeblood of the entire economy, stopped. Banks didn't trust the assets on their own books, so how could they possibly trust the assets on anyone else's? This is the moment the government, the ultimate backstop, was forced to step onto the stage. And they were faced with a truly impossible choice. Option 1, let it burn. Adhere to the core principles of free market capitalism. Bad decisions have consequences. Bad companies, no matter how large, should be allowed to fail. Let the dominoes fall where they may. The consequence? A potential full-scale collapse of the global economy. A black hole of value destruction that would make the Great Depression look like a minor recession. Unemployment not at 10% but at 20–30%. A lost generation. Option 2, intervene. Step in and stop the bleeding. But to do that, they would have to save the very institutions whose reckless behavior, greed, and outright fraud had lit the match in the first place. They would have to reward the arsonists for burning down the neighborhood. This is the heart of the too big to fail doctrine. It's a concept that sounds abstract, but in 2008, it became terrifyingly real. The idea is that certain financial institutions are so large, so interconnected, so woven into the fabric of the economy, that their failure would be catastrophic. It's not just one bank going under. It's the bank that holds the payroll for 1 million small businesses. It's the bank that provides the short-term loans a farmer needs to buy seeds for the season. It's the bank whose collapse would trigger a chain reaction, toppling other banks, insurance companies, and even foreign governments. They had become, in effect, financial weapons of mass destruction. Their own failure was the ultimate hostage. And so, in the fall of 2008, the United States government chose option 2. The Treasury Department and the Federal Reserve unleashed a torrent of programs, but the one that seared itself into the public consciousness was the Troubled Asset Relief Program, or TARP. $700 billion. It's a number so large it's almost meaningless. It was a blank check, written by the American taxpayer, handed over to Wall Street. The government started buying up those toxic assets, those mortgage-backed securities that nobody else would touch, and injecting capital directly into the banks. It was the largest government intervention in the economy in history. It was, for all intents and purposes, a bailout. And here is the most crucial, most infuriating, and most important part of this entire story. The bailout created what economists call moral hazard. It's a simple idea with profound consequences. If you know that someone will always be there to catch you when you fall, you're going to be a lot more willing to walk along the edge of the cliff. By saving the banks, the government sent a clear, unambiguous message to the entire financial world. Go ahead, take massive risks. Chase insane profits. Bend the rules. Because if you succeed, you keep the profits. But if you fail, if you blow up the entire system, the taxpayer will be there to clean up your mess. Heads you win. Tails we lose. This single act fundamentally altered the DNA of American capitalism. The principle of creative destruction, the idea that failure is a necessary part of progress, was sacrificed at the altar of systemic stability. The lenders who had knowingly pushed ninja loans, the investment banks that had sliced and diced them into securities they knew were garbage, the ratings agencies that had stamped them with AAA ratings for a fee, they were all ultimately saved. Their executives still got bonuses. Their companies, after a brief, terrifying stumble, were propped back up. In fact, the crisis allowed the biggest banks to get even bigger, as they were encouraged by the government to absorb their failing competitors like Lehman Brothers and Bear Stearns. The power became even more concentrated. And what about the homeowner? The person at the very bottom of this inverted pyramid? Was there a $700 billion bailout for them? No. For them, there was the cold, hard reality of the contract they signed. There were foreclosure notices taped to their doors. There were moving trucks in the driveway. There were millions of families who lost their homes, their savings, their sense of security. The rescue package was for Wall Street. The pain, the consequences, the long, slow recovery, that was for Main Street. This disparity wasn't lost on the American public. The anger was palpable. It gave rise to movements on both the left and the right, from Occupy Wall Street to the Tea Party. Both were fueled by a sense of a rigged game, a system of two-tiered justice. One set of rules for the powerful and connected, and another for everyone else. In the wake of this public fury, Washington did act. They passed the most significant piece of financial regulation since the Great Depression, the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was a sprawling, complex piece of legislation designed to prevent a 2008-style crisis from ever happening again. It put new restrictions on the kinds of risks banks could take. It created a process to safely wind down a failing financial firm, so we wouldn't have another Lehman Brothers moment. And critically, it created a brand new federal agency with a singular mission: to protect American consumers in the financial marketplace. The Consumer Financial Protection Bureau, or CFPB. For the first time, there was a cop on the beat whose only job was to look out for the little guy against the predatory practices of mortgage lenders, credit card companies, and payday loan shops. Dodd-Frank and the CFPB were supposed to be the answer. They were the guardrails put up after the 100-car pileup. They were meant to fix the system, to rein in the lenders, to ensure that the mortgage you sign was one you could actually understand and afford. And in many ways, they did make things safer. The most egregious types of loans, the ones with exploding interest rates and no income verification, were largely outlawed. Lenders were now required to verify a borrower's ability to repay. The Wild West, it seemed, had been tamed. But was it? Or did the fundamental problem remain? The system was saved, but it wasn't truly reformed. The biggest banks were now bigger than ever. The concept of too big to fail was now explicitly part of our reality, not just a theoretical concept. And the underlying incentive structure, the relentless pursuit of profit, the privatization of gains and the socialization of losses, hadn't gone away. The bailout didn't just save the banks. It enshrined a new unspoken rule into the heart of American finance. Some are too important to fail, and others are simply expendable. The game hadn't been changed. It had just been reset, with players who now knew with absolute certainty that no matter how badly they played, they would never ever be allowed to lose. And so, in the smoldering aftermath of 2008, a new narrative had to be written. The public was furious. They had seen their neighbors foreclosed on, their 401ks evaporate, and their jobs disappear, all while the architects of the collapse were handed a blank check from the U.S. Treasury. The political pressure was immense. Anything had to be done to show that the government was back in control, that the casino had been shut down, and that the consumer would finally be protected. Enter the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was a beast of a law, over 2,300 pages long. It was the most sweeping financial regulation since the Great Depression, a legislative leviathan designed to tame Wall Street and fundamentally reshape the mortgage industry. Its aims were noble: to promote financial stability, to end the concept of too big to fail, and to protect American families from the kind of predatory practices that had lit the fuse of the crisis. And at the very heart of this new legislation was a brand new federal agency, a new sheriff in town with a single focused mission: to look out for the little guy. The Consumer Financial Protection Bureau, or CFPB. Before the CFPB, consumer protection was scattered across 7 different government agencies. It was a confusing patchwork that had allowed predatory lenders to operate in the shadows. The CFPB was meant to be a focused, powerful watchdog with the authority to write and enforce rules for the entire mortgage industry. The first and most important rule they rolled out was revolutionary in its simplicity. It was called the Ability to Repay Rule. Sounds like common sense, almost laughably so. A lender must make a reasonable, good faith effort to determine that a borrower can actually afford to pay back the loan. That's it. That's the rule. But in the context of the pre-crisis world, the world of ninja loans, of stated income applications where a barista could claim to make a surgeon's salary with no questions asked, this rule was a seismic shift. Suddenly, everything had to be documented. Pay stubs, tax returns, bank statements, letters from employers. The lender wasn't just allowed to verify your income. They were now legally required to. They had to calculate your debt-to-income ratio, or DTI, the percentage of your monthly income that goes toward paying your debts. They had to look at your credit history, your savings, and your other financial obligations. The days of "trust me, I can afford it" were over. Now it was "prove it." To give lenders a clear path and some legal protection, the CFPB created a special category of loans called qualified mortgages, or QMs. Think of a QM as a gold standard, plain vanilla mortgage. It can't have risky features like interest-only payments or negative amortization, where your loan balance actually goes up over time. It can't have a term longer than 30 years. And most critically, it generally requires the borrower's debt-to-income ratio to be 43% or less. If a lender issues a qualified mortgage, they are given a safe harbor. They are presumed to have complied with the Ability to Repay rule. This is huge for the lender. It shields them from lawsuits from borrowers who might later claim they were given a loan they couldn't afford. So, naturally, what kind of loans do you think lenders wanted to make? Almost exclusively qualified mortgages. The QM became the new assembly line. If you fit neatly into the QM box, the path to a mortgage was clear, albeit paved with a mountain of paperwork. But what if you didn't? What if you were a freelance graphic designer with fluctuating income? What if you were a small business owner who reinvested most of your profits back into the company, so your taxable income looked low on paper? What if you were a waitress who made most of your money in cash tips? Before the crisis, a local loan officer at a community bank might have been able to sit down with you, understand your unique situation, and make a character-based judgment call. But in the new post-Dodd-Frank world, that became incredibly risky for the lender. Making a non-QM loan meant taking on massive legal liability. If that freelance designer defaulted 2 years later, they could sue the bank, claiming the loan never met the Ability to Repay standard. For a small community bank, one or two such lawsuits could be devastating. The big banks, with their armies of lawyers, could better manage that risk. But the smaller players? They were terrified. And so an unintended consequence began to emerge. The very regulations designed to protect consumers started to lock some of them out of the market entirely. The credit box, which had been wide open before 2008, was now slammed shut and bolted. If your financial life didn't fit the rigid, standardized model of a W-2 employee with a steady paycheck and a low DTI, getting a mortgage became exponentially harder. The system was made safer, but it was also made more rigid, less human, and less accessible for millions of creditworthy Americans who just didn't fit the mold. This created another, even more profound consequence. The cost of compliance skyrocketed. Lenders had to hire more staff, invest in new software, and pay for more legal oversight just to process a single loan application. A mortgage file that used to be an inch thick now became 3 or 4 inches thick. The process got longer, more intrusive, and more expensive. And who do you think ultimately paid for all that extra overhead? The consumer, of course. Closing costs went up, fees increased, and this new high-cost, high-compliance environment disproportionately favored the giants. The Wells Fargos, the Bank of Americas, the JP Morgan Chases of the world could afford to build out massive compliance departments. They could spread the cost over millions of loans. A small credit union or a local bank in rural Nebraska couldn't. They struggled to keep up. Many simply gave up originating mortgages altogether. Others were forced to merge with larger institutions. The result was a quiet, creeping consolidation of the industry. The very too big to fail banks that had caused the crisis were, ironically, the best equipped to thrive in the new regulatory environment created to punish them. The regulations, born from a desire to rein in the behemoths, ended up clearing the field of their smaller competitors, making them even bigger and more powerful than before. The fundamental machine, however, remained unchanged. The business model was still about origination, creating the loan, and then selling it. The secondary market, where Fannie Mae and Freddie Mac were now in full government conservatorship, was still the ultimate destination for the vast majority of these new, heavily documented, safer loans. The assembly line was still running. It had just been retrofitted with new safety guards and 1,000 new inspection points. The lender was still a middleman, but now they were a middleman with a much thicker rulebook. Their incentive was still to close the loan and sell it, collecting their fee in the process. The difference was that the risk of the loan blowing up in their face, through a lawsuit or a buyback demand, was now much higher. So they became incredibly risk-averse. They weren't underwriting a person anymore, they were underwriting a file. They were checking boxes on a form, feeding data into an algorithm, and praying that the final product would be a perfect, lawsuit-proof qualified mortgage that could be sold off without a second thought. The system hadn't been reinvented, it had been reinforced. The cracks in the foundation had been patched over with layers of regulatory concrete. But the house itself was the same. It was still a house built on the principle of originating to distribute, of turning a person's dream of homeownership into a tradable financial instrument. The players were just more cautious now, the rules of the game more explicitly defined. But the ultimate goal, to keep the mortgage machine humming and the bonds flowing, was exactly the same. The question that lingered in the quiet halls of the Treasury and the Federal Reserve was a terrifying one. Were all these new rules and regulations enough to prevent it from all happening again, or had they just built a more complicated, more expensive, and more exclusive version of the very same time bomb? The answer was complicated. It wasn't a simple yes or no. The architects of the new financial world didn't just patch the holes in the old system. They ripped out the foundation and poured a new one. The central philosophy of mortgage lending was forcibly changed. Before 2008, the guiding question for a lender was, "Can I sell this loan?" After 2008, the law demanded they answer a very different question first. Can this borrower actually repay this loan? This wasn't a suggestion. It was a mandate carved into law by the Dodd-Frank Act and enforced by a powerful new watchdog, the Consumer Financial Protection Bureau, or CFPB. And it all boiled down to two little acronyms that would come to dominate the life of every loan officer and homebuyer in America: ATR and QM. First, ATR, the ability to repay rule. This was the sledgehammer. It made it illegal for a lender to give you a mortgage without first making a reasonable, good faith determination that you could afford to pay it back. It sounds like common sense, right? Shockingly, it wasn't the law of the land before. The ATR rule laid out 8 specific things a lender had to verify and document: your current income or assets, your employment status, your credit history, the monthly payment for the new mortgage, payments on any other mortgages you have, payments on other debts like car loans and credit cards, your monthly debt-to-income ratio, and finally, the monthly payment for property taxes and homeowners insurance. Gone were the days of stated income or ninja loans, no income, no job, no assets. The new era was the era of show me the paperwork. Every dollar of income had to be proven. Every debt had to be accounted for. The lender was no longer just a middleman. They were now a legally liable underwriter of your entire financial life. If they gave you a loan you couldn't afford and you later went into foreclosure, you could sue them, claiming they violated the ability to repay rule. This was a terrifying prospect for lenders, a legal minefield where one wrong step could lead to catastrophic losses. So, how could a lender protect themselves? How could they prove to the government, to the courts, to everyone that they had done their due diligence? That's where the second acronym comes in, QM, the qualified mortgage. Think of the ATR rule as the law, and the QM rule as the government-approved how-to guide for following that law. If a lender issued a loan that met all the specific, rigid criteria of a qualified mortgage, they were granted a safe harbor. This meant it was legally presumed they had complied with the ability to repay rule. It was their shield. If a borrower with a QM loan defaulted, it was incredibly difficult for them to sue the lender, because the loan itself was proof that the lender had followed the rules. So what made a mortgage qualified? It had to be a straight-laced, plain vanilla loan. No risky or toxic features were allowed. That meant no more interest-only payments where your balance never goes down. No more negative amortization liar loans, where your balance actually grew every month. No more balloon payments that could explode in your face after 5 years. The loan term couldn't be longer than 30 years. And critically, the points and fees the lender could charge were strictly capped. But the most important, most impactful feature of the original QM rule was the hard and fast ceiling on your debt-to-income ratio, or DTI. Your DTI is the percentage of your gross monthly income that goes toward paying all your debts, your new mortgage payment, property taxes, car loan, student loans, credit card payments, everything. To get a qualified mortgage, your total DTI could generally not exceed 43%. Not 44, not 45, 43%. It was a bright red line. This new, rigid world created a very different kind of bottleneck. The system was now much safer. The loans being written were far more stable. But it was also a much narrower path to homeownership. The rulebook was written for a specific type of borrower. The W-2 employee with a steady paycheck, a long job history, and predictable finances. But what about everyone else? What about the millions of Americans who didn't fit that mold? Consider a hypothetical borrower. Let's call her Sarah. Sarah is a freelance graphic designer. She's incredibly successful. She made $90,000 last year and is on track to make over $100,000 this year. She has excellent credit, minimal debt, and a hefty 20% down payment saved up. In 2005, she would have been a dream borrower. But in 2014, she was a lender's nightmare. Why? Because her income wasn't a neat, tidy paycheck that arrived every 2 weeks. One month she might invoice $12,000 for a huge project. The next it might be $4,000. Her 2 years of tax returns showed a great average income, but the underwriting software programmed for the new QM world saw only volatility and risk. She didn't have a W-2. She had a 1099. The automated systems couldn't easily verify her current income in the way the rules demanded. The 43% DTI rule was a wall she couldn't climb, because the bank struggled to calculate what her income actually was on a consistent monthly basis. Sarah and millions like her, small business owners, commission-based salespeople, gig economy workers, retirees with substantial assets but low taxable income, were becoming mortgage misfits. They had the ability to repay, but they couldn't prove it in the specific way the qualified mortgage rulebook required. They were financially sound but locked out of the very system designed to protect them. The market, as it always does, saw a void. And into this void stepped the non-QM loan. Now, hearing that term might send a shiver down your spine. A loan that isn't qualified. It sounds like we're right back in 2006, doesn't it? But this was a different beast entirely. Non-QM wasn't a return to the lawless Wild West. The fundamental law, the ability to repay rule, still applied to every single loan. A lender making a non-QM loan still had to rigorously document that the borrower could afford it. The difference was the risk. With a non-QM loan, the lender lost their safe harbor protection. They were taking on a higher legal risk. If a non-QM borrower defaulted, it was much easier for them to sue the lender. So to compensate for this added risk, Lenders charged slightly higher interest rates and often required larger down payments. This created a new category of lending for people like Sarah. Instead of providing W-2s, she could get a bank statement loan, where the lender would analyze 12 or 24 months of her business bank statements to verify her income and cash flow. For real estate investors who own multiple properties, there were debt service coverage ratio loans, which qualified them based on the rental income of the property they were buying, not their personal DTI. For wealthy individuals with vast stock portfolios but low taxable income, there were asset-based loans that qualified them based on a percentage of their assets. This was the great trade-off of the post-crisis world. The front door to homeownership, the QM loan, was now narrower, more heavily guarded, and built to a very specific size. It was safer, but it excluded a growing number of creditworthy Americans. In response, the market built a side door, the non-QM loan. It was a more expensive and more rigorous entry point, but it provided a pathway for those who didn't fit the new, one-size-fits-all model. The pendulum had swung. From a system that was dangerously loose, it had swung to one that was, for many, prohibitively tight. The new rules had successfully defused the old time bomb, the one made of toxic, no-doc, negative amortization loans. But in its place was a new, complex machine. A machine that produced safer loans, yes, but also a machine that made it harder and more expensive for anyone outside the traditional 9-to-5 workforce to buy a home. The government had rewritten the rules for how a loan gets made at the local bank branch. But what about the rest of the system? What about that colossal secondary market, the hidden world where these loans are bought and sold? What happened to the giants, Fannie Mae and Freddie Mac, after the American taxpayer bailed them out to the tune of $187 billion? The answer to that question reveals how the interest rate you see advertised online is actually decided, and why the fate of the entire housing market still rests in the hands of two companies that technically don't even exist to make a profit. Their names are Fannie Mae and Freddie Mac, and they are the ghosts in the machine of the American housing market. To understand them is to understand the hidden architecture of the entire system, the invisible hand that sets the price of the American dream. Fannie Mae is the nickname for the Federal National Mortgage Association, created in 1938. Freddie Mac is the Federal Home Loan Mortgage Corporation, born in 1970. They were established by the U.S. Congress, not as typical government agencies, but as something strange and in between, government-sponsored enterprises or GSEs. Their mission was noble, born from the ashes of the Great Depression. Back then, banks were terrified to lend. A mortgage was a 30-year ball and chain. A bank would lend a family money, and then have to wait 3 decades to get it all back, collecting interest along the way. That meant their cash was tied up, frozen. If they wanted to make more loans, they needed more cash, but theirs was locked away in these long-term commitments. The result? Almost no one could get a loan, and the housing market was paralyzed. The government needed a way to thaw this frozen capital. The solution was Fannie Mae. The idea was brilliant in its simplicity. Fannie would create a secondary market for mortgages. Imagine a local baker who makes bread. To make bread, he needs flour. If he uses all his flour to make 100 loaves, he can't make any more until he sells those loaves and uses the money to buy more flour. Now, what if a giant government-backed distribution company came to the baker and said, "As soon as you bake a loaf, we'll buy it from you instantly for cash"? Suddenly, the baker's problem is solved. He can bake a loaf, sell it immediately, get his cash back plus a small profit, buy more flour, and bake another loaf over and over again. He never runs out of capital. He can just keep baking. In this analogy, the local bank is the baker. The mortgage is the loaf of bread. And Fannie Mae is the giant distribution company. The bank makes a mortgage loan to you, and then, instead of holding it for 30 years, they turn around and sell it on the secondary market to Fannie Mae. This instantly replenishes the bank's cash, allowing them to turn around and make a loan to your neighbor. It's a conveyor belt, a perpetual motion machine for money. This process is called securitization. Fannie Mae would buy thousands of these individual mortgages, bundle them together into a giant financial casserole called a mortgage-backed security, or MBS, and then sell slices of that casserole to big investors on Wall Street like pension funds and insurance companies. This solved the liquidity problem. It kept money flowing into the housing market, making mortgages cheaper and more accessible for everyone. Freddie Mac was created later to do essentially the same thing, providing competition and further expanding the market. And this is the direct answer to how that interest rate you see online is decided. Because Fannie and Freddie were buying up all these loans, they needed to standardize the product. Just like our baker's distributor might say, "We'll only buy your bread if it's made with whole wheat, weighs exactly 1 pound, and is baked at 400 degrees. Fannie and Freddie set the rules for the mortgages they would buy. They dictated the maximum loan amount, the minimum credit score, the required down payment, the debt-to-income ratios, every single detail. A loan that meets all these criteria is called a conforming loan. And because lenders want to make loans they can easily sell, they overwhelmingly choose to make conforming loans. The entire industry began to mass-produce mortgages that fit Fannie and Freddie's exact specifications. This created a vast, liquid, and stable market for one specific type of loan. The interest rate for that standardized, conforming loan became the baseline. It's the reference point for the entire market. The rate you see advertised is almost always the rate for a perfect conforming loan, for a borrower with a great credit score and a 20% down payment. Your specific rate will be an adjustment up or down from that baseline, depending on how well you fit the perfect mold. So, for decades this system worked. It fueled the post-war housing boom and made the 30-year fixed-rate mortgage an American institution. But there was a fatal flaw, a deep inherent conflict at the heart of these two companies. Remember, they were government-sponsored enterprises. This meant they were also private companies with stock traded on the New York Stock Exchange. They had shareholders who demanded profits, and executive teams who were paid massive bonuses for hitting growth targets. So you had this bizarre hybrid. A company with a public mission to make housing affordable, but also a private mandate to make as much money as possible. And crucially, everyone on Wall Street believed that because of their special congressional charter, the U.S. government would never let them fail. This was the implicit guarantee. It was like a casino giving its high rollers an unlimited line of credit, knowing the house would cover any losses. It encouraged reckless behavior. In the late 90s and early 2000s, the pressure mounted from both Washington and Wall Street to expand homeownership to everyone, including those with less than perfect credit. Fannie and Freddie, chasing profits and political goodwill, began to lower their standards. They started buying and guaranteeing trillions of dollars in riskier loans, including the infamous subprime mortgages we discussed earlier. They were no longer just buying the high-quality, whole wheat bread. They were buying anything the lenders could bake, no matter how shoddy the ingredients. They became the ultimate engine of the housing bubble, using their government backing to hoover up toxic assets from the entire financial system. And when those subprime loans began to default in 2007 and 2008, the mortgage-backed securities they had created and guaranteed became worthless. The losses were catastrophic on a scale the world had never seen. Fannie and Freddie were hemorrhaging billions of dollars a week. They were insolvent. The implicit guarantee was finally called in. If they failed, the entire global financial system would vaporize. So in September 2008, the US government did the unthinkable. It seized control of both companies, placing them into a state of conservatorship. It was the largest financial bailout in American history. The government effectively became the CEO and the sole shareholder, wiping out the private investors. Taxpayers pumped in over $190 billion to keep them afloat. And here is the most astonishing part of this entire story. That conservatorship was supposed to be temporary. It's now been over a decade and a half, and they are still under direct government control. Today, Fannie Mae and Freddie Mac don't just influence the market. They are the market. They buy or guarantee nearly 2/3 of all new mortgages in the United States. The rules they set are not suggestions. They are the law of the land for lending. The government, through these two zombie corporations, now directly underwrites the American housing market. The private lenders you deal with, the Quicken Loans, the Wells Fargos, the local credit unions, are in many ways just the public-facing storefronts for this massive government-run mortgage machine. They originate the loan according to Fannie and Freddie's rulebook, and then sell it up the chain. So the fate of the market, the availability of credit, and the interest rate on your next home loan rests in the hands of two entities that were driven into the ground by a toxic mix of public mission and private greed, and now operate as wards of the state. We've unraveled the entire system from the loan officer's cubicle through the underwriting department, past the appraisal, and all the way to the very top of the financial food chain. We've seen how the money flows and who truly holds the power. But what does this all mean for you? Now that you can see the whole board, how do you play the game to win? It means you stop being a passenger and you start being the pilot. The entire mortgage industry, from your local loan officer to the bond trader on Wall Street, is a system. And like any system, it has rules. The people who win are the ones who know the rules better than anyone else. Your goal is not to break the rules, but to use them to your absolute advantage. So let's lay out the winning game plan. It's built on 3 core pillars: fortifying your position, dominating the marketplace and controlling the process. First, you must fortify your position. Before you even think about talking to a lender, you need to become the borrower they dream about at night. You need to become, on paper, the perfect applicant. This isn't about being rich. It's about being responsible. It starts with the single most important number in this entire game: your credit score. We've talked about how lenders and investors use this score to price your risk. A low score screams danger, and they will charge you a premium for that danger in the form of a higher interest rate, costing you tens of thousands of dollars over the life of the loan. A high score whispers reliability, and they will fight each other to give you their cheapest money. Your credit score is your financial armor. To build it, you wage a patient, disciplined war. You pay every single bill on time every time. No exceptions. You become obsessed with your credit utilization ratio. That's the amount of credit you're using compared to your limit. Keep it below 30%. If you really want to win, keep it below 10%. You don't close old credit card accounts, because that shortens your credit history and reduces your available credit, which can actually hurt your score. And you pull your credit report for free and you hunt for errors like a hawk. One mistake, one fraudulent account, can be the difference between a prime rate and a subprime nightmare. Next, you master your debt-to-income ratio, or DTI. This is the lender's X-ray into your financial health. They add up all your monthly debt payments, student loans, car payments, credit cards, plus your new potential mortgage payment, and they divide it by your gross monthly income. If that number is too high, alarms go off in the underwriter's head. It tells them you're over-leveraged and one missed paycheck away from disaster. The winning move? Go on a debt diet before you apply for a mortgage. That new car can wait. Aggressively pay down high-interest credit cards. The lower you can crush your DTI, the more powerful your application becomes. You're not just a borrower. You're a fortress of financial stability. The second pillar: dominate the marketplace. This is where you shift the power dynamic. Most people walk into their local bank, the one they've used for a decade, and meekly ask for a mortgage. This is a catastrophic mistake. Loyalty is a one-way street in banking. You are not asking for a favor. You are a highly valuable customer about to sign up for a 30-year, six-figure contract. You need to make lenders compete for your business. You need to make them fight for you. This means you must shop around. I want you to apply with at least 3 to 5 different lenders on the exact same day. A local bank, a credit union, a national online lender, and a mortgage broker. People are terrified to do this. They think, oh, it will destroy my credit score. This is a myth. The credit bureaus know how this works. All mortgage-related credit inquiries made within a 14 to 45-day window are treated as a single event. It's called rate shopping, and it will have a minimal temporary impact on your score. The potential savings from finding a better loan will dwarf that tiny dip 1,000 times over. When the lenders send you their official loan estimate, you don't just look at the interest rate. That's the amateur move. The pros look at the entire document. You compare Section A, origination charges. This is where lenders hide their pure profit. One lender might offer a slightly lower rate but charge you $3,000 in processing and underwriting fees, while another has a slightly higher rate but only $500 in fees. You have to do the math. You have to compare apples to apples. Ask them about points. Is it worth paying an extra $2,000 up front to buy down the rate? It depends on how long you plan to stay in the home. You need to be the one asking these questions. And consider using a mortgage broker. A good broker is like a personal shopper for loans. They have access to dozens of wholesale lenders you've never heard of, and they can often find niche products or better rates than you could find on your own. Their job is to find you the best deal because that's how they get paid and earn your referrals. This brings us to the third and final pillar: control the process. From the moment your application is submitted to the day you get the keys, you are the CEO of your home purchase. The loan officer, the processor, the underwriter, they work for you. Your job is to make their job as easy as possible. This means you prepare your documentation like you're preparing for a trial. Before you even apply, create a digital folder. Scan and label everything. 2 years of W-2s and tax returns, 60 days of bank statements for every account, 30 days of pay stubs, your driver's license. When the underwriter asks for a document, you don't spend 2 days digging for it. You reply to the email in 5 minutes with the perfectly labeled PDF attached. This doesn't just speed things up. It sends a powerful signal that you are organized, serious, and on top of your finances. You are a low-risk, low-hassle applicant. and you must read everything. Don't just sign where they tell you to sign. When you get that final closing disclosure at least 3 days before closing, you print it out. You print out your last loan estimate, and you put them side by side. You go through them line by line. Does the loan amount match? Is the interest rate correct? Did a junk fee suddenly appear out of nowhere? Mistakes happen. Numbers get transposed. A $10,000 error can be fixed with a phone call before closing. After you've signed, it's a legal nightmare. You are the final line of defense for your own money. So, what is the ultimate secret? After all of this, what's the one thing to remember? It's this. The entire mortgage system, from top to bottom, is not designed to help you buy a house. It is a machine designed to do one thing: manage risk. Every form you fill out, every document you provide, every number on your credit report is fed into this machine to calculate the probability that you will fail to pay them back. Your job is not to fight the machine. Your job is to understand it so deeply that you can feed it exactly what it wants to see. You present yourself as the lowest possible risk. A high credit score reduces risk. A low DTI reduces risk. A stable job history reduces risk. Ample cash reserves reduce risk. Shopping for the best lender reduces the risk of you getting a bad deal. Being organized and responsive reduces the risk of the deal falling apart. By understanding how mortgage lenders really work, you transform from a supplicant into a strategist. You're no longer a pawn in their game. You're a player at the board, anticipating their moves and making your own. This knowledge is the key that turns one of the most stressful, confusing, and intimidating financial transactions of your life into a deliberate, confident, and powerful step toward building your future. You now see the whole board. Go play the game to win.